first one up here is this little 3-minute clip here. Tom Lee. Oh, yeah, Tom Lee had to make his CNBC appearance. So we're going to watch that, react to that one together. All right, guys, let's get into this.
Market panel, Tom Lee of Fundstrat and Jose Rasco of HSBC Global Private Banking and Wealth. Good afternoon to you both. I mean, it was a record week for the S&P, the Dow, and the NASDAQ, even though we slipped here in trading for the Dow and the S&P. Just the fact that we did reach new highs this week. Tom, I will start with you. How much of this is Fed? How much of this is ongoing AI enthusiasm? How much of this is economic data that continues to surprise to the upside?
It's all of the above, Morgan. It's always a good sign when not only is the S&P 500 making a new all-time high and, building on 4 consecutive months of gains, but it's coming when the other important indices like the NASDAQ and the Dow confirm those highs. I think we got a lot of good economic data recently. The economy is very resilient and corporate profits have been also surprising to the upside. But now we have monetary policy that is confirmed to be dovish, and at a time when there's $6 trillion of cash on the sidelines. So to me, these are all positive signals for stocks to make further gains. And I think sentiment continues to be overly cautious.
Okay. Jose, how do you see this?
So the big mistake everybody's making out there, I mean, this is a huge mistake. And I'm talking Wall Street, I'm talking hedge funds, I'm talking big-time investors. Massive mistake they are making right now is assuming whatever the Fed is talking about is going to happen in the future. And we just know that's not reality. We know that's not reality, right? We know the Fed always gets it wrong. Always. And so I think anybody jumping to the conclusions and thinking, oh, the Fed's going to do this because they're saying they're going to do this a year from now. And the Fed says inflation's going to be here a year from now. And they say GDP is going to be this a year from now. And they say, 2 years from now, the unemployment. Guys, no, it's not the way it works at all, okay? Not even remotely close. The Fed is wrong consistently and a lot, especially for any predictions that are long-term predictions. Anything a year from now, even 6 months from now, but a year from now, 2 years from now, they're wrong all the dang time in regards to that, right? Now, short term, maybe they can predict 1 month versus another month, but I'm talking about like a year from now, 2 years from now. So I think anybody drawing any conclusions about where the Fed funds rate is going to be 18 months from now, based upon what their data is or what they're saying, it's not accurate. I mean, 18 months from now, I wouldn't be surprised if the Fed funds rate was near 0. I also wouldn't be surprised if the Fed funds rate was, 7. So, it was we get another batch of inflation, let's say, in the economy. The Fed's going higher rather than lower. But that would have to be a big batch of inflation. We need oil prices to go flying. You need lumber to go flying. You need a lot of different things to happen, natural gas. But if that did happen for some reason, the Fed's going higher then, right? And then that would be very, very devastating this time around because we're not in as strong of a situation now as we were when we went into the first Fed rate hike cycle. At the same time, if the economy falls apart in the next 18 months, Fed's taking rates down to nothing. We know that.
We have seen market leadership broaden out as well. You've now got something like 80% of the S&P 500 constituents trading above 200-day moving averages. And we did get not one, but 2 strong IPO debuts in this market this week, too.
Yeah, look, we agree with a lot with what Tom said, but I think if you look, the cyclical side of the economy is probably going to slow because rates are high. And even if the Fed cuts, rates are still high. So the cyclical side, we should see some slowing. But you've got the 4 underlying secular themes that are going to continue to drive the economy upward. And we think multiples out and the market upward as well. So we're still bullish on U.S. equities. And remember 94, 95. At the beginning, it was a couple of stocks that led this whole thing on the tech side, and that broadened out. And we have not yet seen the power of the productivity gains we're going to see here from AI and a host of other technologies, right? And I think that has yet to happen, and that's going to help boost earnings as we go forward. And that's positive for markets. So yeah, we're bullish as well.
Okay, so Jose, when I hear you talk about cyclical parts of the market, maybe perhaps slowing here. I mean, we do have industrials trading at a record high, materials, some of these other more cyclical sectors. Does that mean that you take a step back as an investor right now and say maybe take some profits, maybe put your money to work in other parts of the broader market?
I think you're going to see that just from a valuation perspective, right? Growth has outperformed value dramatically this year, right? Year to date. And I think that's going to factor into people's decisions. You can you can dollar cost average your way into some pretty good stories in other sectors. But the growth perspective remains in place. And we think that's where you want to be. Remember, look at the Philly Fed from yesterday. The top line number was not great. But if you look at prices paid, came down a ton. New orders soared. And most importantly is the Philly Fed CapEx index. And that's something that for Tom's ideas and mine is crucial, because it's telling you corporate America is still investing in long-term planning to build a more resilient economy. And they want to make sure they're on the front burner of that, not at the end of the train. So I think you're going to continue to see that. That's going to help lift valuations. But clearly, there's going to be some rotation of value here as growth has outperformed dramatically.
So to push back against that a little bit, okay, and then we'll get into this video, which is very important for all PayPal shareholders. To push back against that for a moment, right? Remember what I just told you, right, about the Federal Reserve and, 1 year out, 2 years out, they can completely change plans. Keep in mind, corporations can change plans as well, right? They can go from investing very heavily in their business to pulling back substantially. This happens all the time in corporate business. When you have any sort of big fluctuation, let's say in the economy, things go much better than expected, much worse than expected. All of a sudden, companies can go from, look at 2022, and then into 2023, a lot of companies were talking cautious. Then going into 24, a lot more optimistic, a lot more about investing in their businesses, right? And that's a change just in a year, right? And so these things can change very quickly. So don't just assume all companies are talking about, investing in their businesses so heavily for the next many years. That could change, okay? That could change, folks, okay? So just a little food for thought in regards to that. Future Investing channel going over PayPal, and I want to show you the numbers he's working with here and kind of react to this, give my opinions and perspectives, because it makes a pretty decent argument that PayPal could be actually the best deal in the S&P 500 right now. So we'll get into that one. Let's get into this.
Recently that said that I'm focusing way too much on the product side of PayPal and not enough on the actual stock to see if it's undervalued enough to be worth a buy. It kind of got to me for some reason, so I just wanted to obliterate that case. So this is exactly what ended up happening. I ended up creating a spreadsheet that went across 25 of the largest retail companies, including PayPal and a lot of their competitors. So you can see here like Global Payments, Fiserv, Adyen, Visa, MasterCard, a bunch of different payment companies. But then also I wanted to add in a wide range of different styles of companies. We have healthcare, we have oil and energy, we have, NVIDIA and Google and Tesla and all really high growth companies. But then on the other side, we also have like Altria and Philip Morris and a lot of the more value type plays or a whole range of different companies and everything in the middle. I then wanted to get the full earnings for these companies with three metrics that I thought could be as well compared as possible: revenue, net income, and free cash flow. Those I thought were pretty good. Then looking at the different growth rates of those companies through a historical 5-year revenue, historical 5 years of earnings per share, forward-looking earnings per share, and then forward-looking free cash flow as a percent basis, right? Then I wanted to go through and look at the valuations of all of these companies.
Before we go further here, it's very important whenever you're thinking about potentially investing into a company and trying to figure out if a stock is a great deal or you're getting ripped off. Very important that you aren't just looking at the past and what companies did in the past. You've also got to be able to look to the future, see what analysts are projecting the stock to do in the future. Also think to yourself, can this company maintain its past growth rates? Or is there something going on with the business model that's going to make its growth rates much better in the future, right? Think about NVIDIA. I mean, NVIDIA obviously over the past year has been going through a super cycle for their AI chips. That completely changes the revenue growth model than versus a year ago or something like that, right? On the flip side, it could be like, PayPal, for instance, past growth, we can say around 15%. I'm not expecting PayPal to be growing that much per year. I'm expecting PayPal to be kind of more in the, we can call 7 and 9% revenue growth range. If they ever get back up to double digits, oh man, I'm going to be a very, very happy camper. That means Alex Chris is really doing them well. But, so that's just a little factor and something important to keep in mind there.
Price to sales, price to earnings growth or PEG ratio, and then price to free cash flow. Looking at every single one of those metrics, we can go through and select these companies and see which company has the lowest price to sales or which company has the lowest price to earnings value, which is a very important metric, right? So
now, real quick here, price to sales only matters if you're comparing two companies that are extremely similar. If you're comparing, the price to sales ratio of a Walmart versus a Microsoft, it's not even worth doing because they're going to trade at completely different price to sales ratios. Because a company like Walmart's a massive revenue company, but you think about it, they sell a product for $1, they actually make very little margin on that, right? Somebody like a Microsoft might not be as impressive of a revenue number, but their profitability is off the charts, right? Because once they create a product, that's it, and now it's just pure profit basically rolling in.
To notice already is that companies like Altria, Johnson & Johnson, ExxonMobil, and PayPal, show up very, very low or very high up on the low price to earnings ratios, where the very fast growing companies like the Eli Lillys, the AMDs, the NVIDIAs, Salesforce, they're going to rank really low because those are the very fast growing textile companies, right? So that is sort of across the board. Now, there's another metric that we need to look at whenever it comes to valuing these companies, and that's distributions, buybacks, dividends, and paying down debt. That is what can sort of adds into the shareholder yield, okay, which we'll look at these distributions. So at the top, Altria, they're making cigarettes. There's not a whole lot of innovation going on. They have so much money to pour back into dividends. So they're going to be very high on this list, all the way down to, the very small companies on the other end. Let me sort by this. So Eli Lilly being at the very bottom, Global Payments, sort of these companies that might even be taking on a ton of debt rather than worrying about paying down debt or trying to do dividends or buybacks or something like this. So that's how you can get into the negatives if they're adding on debt. But most of these companies in the positives, and we can kind of rank them against each other. Now, instead of just going through and looking at all of these different metrics to see where PayPal ends up lying, right? I wanted to end up creating a ranking system so then we can value some parts of this company better than others. And so what I ended up doing is creating a scoring list. We have a score list for all of the different metrics for, here, let me move my camera really quick. So whenever comparing all of these different companies, if we want to look at, let's say, revenue, for example, then you can see that all the way 1 through 25, where each company lies. So at the bottom here for, revenue growth rates, we have Altria, Philip Morris, McDonald's, Walmart, Johnson & Johnson, PepsiCo, what we really think of often as, value stocks. And on the other side, we have all the growth stocks, right? Adyen, Tesla, Fiserv, AMD, NVIDIA, Global Payments, very common growth names. But how do we take a mixture of all of this? Because whenever you get growth, right, very, very, like Adyen's ranking very high on growth, 1, 3, 8, 4. But then on the other side, on valuation, they're ranking extremely expensive, 24, 21, 14, 10, right? So where can we find a company that sort of lands in the middle of all of these and kind of gets you a great amount of growth while not paying a high amount of value for that, right? Or on the multiple side, while potentially also adding on that heavy yield. So I created sort of a golf scoring, grabbing all of the metrics across every single different growth rate and putting them together to create a score that, if you rank the lowest, is actually the score that you want the most. I called it my golf score. Creative, right? I know. But if we sort this by lowest to highest, meaning the lowest from every single growth metric and every single valuation metric, what we end up seeing is that PayPal ends up being the lowest across every single metric. Now, this is because, the revenue is where they rank the lowest, but it's still a 10 out of 25. On their highest for PEG ratio, they are literally number 1 on the list. Now, this isn't seeming to be unpopular. 3 of the companies in this golf scoring are also payment companies. Now, this does not mean that the companies that are scoring the lowest, Eli Lilly, Costco, Microsoft, that these are the worst companies to be buying, because that obviously is not true either. So
No, but think about this for a moment. Let's take a moment and just think about this logically, okay? So Microsoft, Eli Lilly, Costco, were some of the lowest scoring on that list, right? As he points out, they're not bad companies. That doesn't mean they're bad companies. But play a little chess for a minute. What are some of the most overcrowded trades in the market, right? If you were to think about that. Overcrowded trades, meaning essentially companies that it just seems like everybody's just in. And it just seems like, geez, man, like those stocks have been beasts, but just everybody seems to be invested in those. Well, a few of the stocks that come to mind are Eli Lilly, Microsoft, and Costco, right? Costco's valuation is pretty dang high right now. I mean, it's actually insanely high on a PE basis, a forward PE basis. It's actually trading at some of the highest valuations we've ever seen it trade at. And that's with, Costco still has growth in the future, but does Costco still have the same level of growth it did 10 years ago or 15 or 20 years ago? Of course not, right? So that's just a little food for thought in regards to that. Eli Lilly, everybody wants to play those type of plays. Novo Nordisk and all those sorts of companies, right? And Microsoft always trades at a very rich valuation. It seems like one of those that just a lot of Wall Street, almost every fund manager wants Microsoft in their portfolios.
What I want to preface this chart with is the fact that this does not talk about macro. This does not talk about the quality of the earnings, like whether a company has brought on a ton of new money in a one-time event versus reoccurring revenue that can be extremely consistent, like Costco, for example, right? So there's a whole bunch of different factors that we have to weigh in that aren't necessarily being shown in this golf scoring. Probably the most prominent thing that we're not seeing here is that idea of competitive moats, right? Competitive moats, regulatory concerns, these sorts of things are not stuff that you're going to end up seeing on this list, because that's the reason why PayPal is getting such a discount right now, is because people think that they are losing that competitive edge versus companies that will be so sticky like MasterCard or Visa. Those companies are not losing their competitive edge, and so they continue to hold up very expensive valuations that are scoring them much lower on this, golf ranking. But in my opinion, while continuing to look at forward earnings per share, forward free cash flow, that PayPal, in my opinion, is currently worth the risk reward for my portfolio. Ladies and gentlemen, remember, this is just a company that I'm buying for me.
So before we go further here, and we get into the Visa, MasterCard thing, and the Goldman Sachs and the Tesla thing here, let's just finish out around PayPal, right? Do I put PayPal as the best deal in the stock market? Well, if it's not the best deal in the stock market, I think it's definitely one of the best deals in the stock market, risk-reward profile. If you think about the level of risk you're taking in this stock, which I always think about, what are the chances I could lose 50% or more on this stock, right? Versus make 100% or more on this stock, right? That's how my brain always goes in regards to risk-reward. And the risk-reward for PayPal is just insanely attractive. Now, as he spoke about there, there's a lot of worries about competitors or Apple Pay or just all these different worries in general. New management that stock's pretty much had anything thrown at it in the past, I would say 2 to 3 years. But it is what it is. Now I think it's just a clear path forward. It's a clear path up and away. So we'll see. So far, it looks like the stock had a very nice bottom, and we're going up from here. And I think outside of anything very detrimental to their business model, it's up and to the right from here, basically, okay? It's not going to be, every day up, but the overall trend will be up for the next couple of years. But we'll see. Now, Apple, Department of Justice, all those sorts of things. How's it all play out for PayPal? How's it all play out for Meta in situations like that, right? First off, PayPal, congrats to shareholders out there. We're finally moving up in the right direction. I just reached a 5-figure club in PayPal stock. It's up over $10,000 now at this point in time, up $11,338. Hopefully a lot more gains coming over time. And that made me think, 5-figure club. If you didn't know, when you're in the Patreon, you got more than 5 figures in your portfolio, you can apply and we'll ship you to one of these awards to your house. If you're in the private stoic group, we got the 6-figure club diamond award, and then we got big dog 7-figure club award, $1 million plus. Plus you get your membership cards there. So once again, if you're looking to join a private group, pin comment down there. If you're looking to join my Patreon, that is going to be in the description area down there, okay? Department of Justice sues Apple over iPhone monopoly in landmark antitrust case. The Justice Department sued Apple in an antitrust case, saying the iPhone maker has a monopoly over the phone market that's harmed consumers, developers, and rival companies. Apple's ecosystem, from Apple Watch to Apple Pay, Apple Pay, supports that monopoly, prosecutors said. The challenge strikes at the core of Apple's walled garden model. Now, before we go further here, let me say this, okay, because I listened to the entire speech and the question and answer session the Department of Justice gave today and the Attorney Generals for the different states, okay? Listen, they got a lot of dirt on Apple. They have emails even going back to Steve Jobs' days. That was a long time ago, okay? And they got a lot of emails that do not portray Apple in the best light and make it seem like Apple's making specific moves to basically, stifle competition, okay? So I would say, based upon the emails I heard, and I'm sure they got so much more dirt than what they gave out there today, they got a lot of dirt. They also likely have dirt from Google, from Meta, because of what the government years ago went after Meta. Obviously, they went after Google. I'm sure they got a lot of dirt there in regards to Apple. I'm sure they've been collecting a lot of dirt on Apple for years now at this point in time. Epic Games, Spotify. So, and who knows if they got a whistleblower or two in Apple. All I'm going to say is they got a lot of dirt across the board on good old Apple, okay? So that's that. The Department of Justice sued Apple on Thursday, saying its iPhone ecosystem is a monopoly that drove its, quote, astronomical valuation at the expense of consumers, developers, and rival phone makers. The government has not ruled out breaking up one of the largest companies in the world, with a Justice Department official saying in a briefing call that structural relief was on the table if U.S. were to win. I don't see that happening. I don't see them breaking up Apple. I think they're going to force changes at Apple, but I don't see necessarily a breakup of the company. I think that's more tough talk of like how bad it could really get for Apple. I think that'd be like worst case scenario. That's pretty far-fetched, but you never know. The Justice Department said in a release that to keep consumers buying iPhones, Apple moved to block cross-platform messaging apps, limiting third-party wallet and smartphone compatibility, and disrupted non-app store programs and cloud streaming services. And as an Apple customer, we all know that. I'm just going to be honest. We all know Apple, has screwed up messaging for the last 10 plus years, and it makes it impossible for you to, we know what it is. I don't even need to explain it to you. If you have an iPhone, you know exactly what I'm talking about. But this is an important part. Limited third-party wallet. Department of Justice says Apple's complete control over tap-to-pay transactions stops innovation and cements its monopoly. In a wide-ranging antitrust complaint against Apple and the iPhone business, the U.S. Justice Department takes specific aim against Apple's massive financial business, specifically how it uses Apple Pay to block competition and make billions of dollars a year in the process. The Department of Justice alleges that Apple is not only stifling competition among payment services, but it is also potentially stifling innovation, since the fees that banks and others fork out to play with Apple Pay make them less inclined to develop other kinds of services that might rival Apple. It's very important. Apple Pay is no stranger to regulatory controversy. In 2020, the EU opened an antitrust investigation into it. And in January 2024, perhaps with a sober regard of the other looming regulatory battles it would be facing this year, Apple finally offered some concessions where it would allow third parties to access its NFC and related technology to build their own tap-to-pay payment services to bypass Apple Wallet and Apple Pay. PayPal, the payments behemoth that has substantial businesses in mobile transactions and point-of-sale technology, was apparently instrumental, so they got stuff from PayPal as well, instrumental in the original EU complaint around Apple's payment monopoly. Contacted today about the DOJ complaint in the U.S., a spokesperson for PayPal said the company declined to comment. It's certainly keeping a close eye on proceedings. The Department of Justice argument: Apple today takes a 0.15% fee on any transaction made via Apple Pay. In 2021, that worked out to about $1 billion. By 2022, that grew to $1.9 billion. And in 2023, it's estimated that the figure more than doubled to $4 billion. Pouring in for Apple now at this point in time from this, right? That's incredible. Absolutely incredible. Now, it's very convenient and interesting that on March 7th, right, just a few weeks ago, PayPal was finally able to open iPhone Tap to Pay for Venmo business users, right? Which kind of feels like Apple knew what was coming here, right? They must have known. Because the fact that all of a sudden all this happens right before the DOJ drops this, that's a little suspicious, right? Now, for Apple, the next 2 to 4 years, they got to be on their very best behavior. Now, this is going to drag out. This is not something that's figured out tomorrow or next week or next month, okay? Something like this is going to take years. Minimum 2 years, in my opinion, but could take up to 4 years, okay? So Apple's going to have to be on their best behavior for a while. And I've watched Apple, I've watched what Apple's done with Meta over the years. I've watched what they've done with PayPal over the years. I've watched what they've done with Spotify over the years. I watched what they did with Epic Games over the years, right? Meta encourages advertisers to ditch iPhone in the latest spat with Apple. This was back from February, last month. Advertisers are steered to a workaround to avoid paying a 30% service charge to Apple for boosted posts. So basically, Apple, if you want to boost your post on, I guess, Facebook or whatever, you have to pay a 30% service charge to Apple, even though you're doing it through Meta, right? Even though you're doing it through Facebook. So this is how wide-ranging this got, and this is where I think Apple's really screwed up in a big way. They've gotten too greedy with it. There's like a fine line of like what they could have gotten away with versus like taking it so far where now you want a 30% service charge for people boosting a post on Facebook? What? Like, it's just ridiculous. So that's how far Apple's gone at this point in time, and I think their greed's probably gotten the best of them in this situation and cooking the whole team, right?